Markets remain very volatile. Using the FTSE 100 as a benchmark, stocks have risen or fallen by more than 1% in a day on 20 occasions so far as I sit here. We've only had 34 trading days. That's left some investors looking for a safe haven. This in turn may explain why gold has done rather well of late, a development we're going to explain in greater detail in this week's edition of Breaking the Mould, our regular markets review. Hello, I'm Russ Mould, AJ Bell's Investment Director, and while oil has grabbed all of the headlines this year, I'm going to look at another commodity that's quietly done the business for investors, at least so far this year. This chart shows the performance of key stock and bond indices as well as gold and oil since the US Federal Reserve raised interest rates last year on the 16th of December. Simple summary: gold first, government bonds, investment grade corporate bonds second and third, the rest nowhere. So, what's the case for gold? 1. It's a traditional safe haven during times of market stress. It roared higher during 2008 to 2011 as the effects of the financial crisis ripped around the world, as this 10-year price chart for gold since 2000 shows very clearly. 2. Gold's actually quite hard to find and produce, so supply only grows very slowly. This is in contrast to paper money, which central banks can frankly create at will at the flick of a switch. Gold is therefore a potential shield against central bank profligacy and any overshoot in their attempts to reach their 2% inflation targets. Third, if interest rates go negative worldwide, you may have to pay to keep cash in the bank. Gold is therefore a potential alternative to cash under those circumstances, and Japan and Sweden, Denmark and Switzerland already have negative interest rates. Now, the case against gold also comes in three parts. 1. It has limited industrial use, generates no yield or cash, and thus, according to some, has no intrinsic value at all. Second, it's not a cheap alternative to cash, some would say, because you have to pay to store the stuff and insure it if you actually own physical bars. And third, it tends to do best when everything else is doing badly. So if the markets believe that central banks will succeed in getting the economy back on track, then gold may again look like a barbarous relic, as former Chancellor of the Exchequer and Prime Minister Gordon Brown once described it. This next graphic takes gold back to 1970, and as you can see, the dollar price has had some very bad runs as well as some very good ones. So whether gold is right for your portfolio will be down to your own personal investment goals, target returns, time horizon and appetite for risk, as well as your worldview. If you do decide to follow the yellow brick road, and that's a decision only you can make, there are several ways to access the metal. First, you can buy an exchange-traded commodity, or ETC, such as ETFS physical gold. Now that's designed to track movements in the underlying metal price and deliver its performance minus running costs. It's possible to buy versions of the ETC which deliver performance in dollar or sterling terms if you're worried about currency movements. Second, you can buy gold miners. Randgold Resources is a member of the FTSE 100, and other London-listed gold diggers include FTSE 250 firms Acacia and Centamin, while major gold miners like Barrick Gold and Anglo Gold Ashanti are listed in the US. Mining shares will tend to rise faster than the metal price, but they'll also fall faster too, so you are going to be taking on greater risk here, especially as miners have their own special characteristics, depending on where they operate, their balance sheets and their management teams. This chart for Randgold goes back 10 years, and as you can see, it's a good example of a volatile stock, even though it produces what is supposedly a safe haven asset. Third, to manage stock-specific risk, you can buy a fund which specialises in precious metal miners. In return for a fee, you'll gain access to a wide pool of gold miners selected by an expert in the area. Options here include BlackRock Gold and General and the Golden Prospect Precious Metals Investment Trust, although they won't be pure gold players and will come with exposure to silver and potentially platinum and palladium miners too. Again, whether gold works for you is down to your own personal financial needs and market views, though it is interesting to see a metal known as a hedge against inflation doing well at a time when the market seemed frightened of deflation. Let's keep an eye on it. Thank you for watching, and I look forward to seeing you next time.